In the past, when the market started to think that the Fed might possibly do a 1% rate increase, the Federal Reserve pushed back on that. The Federal Reserve has not been pushing back. In fact, they've left it wide open as a real possibility. Hi guys, it's Stock Curry, and there's major market news coming out this week that will significantly impact the market. We could see the stock market go up or down 5% this week, depending upon how that news comes out. So let's get into it. The last major economic news before the Fed meets next week is coming out on Tuesday. On Tuesday, the CPI, or Consumer Price Index for August, is being released. This report will be released about 1 hour before the market opens. The Federal Reserve uses the CPI, or Consumer Price Index, to determine how much they are going to raise interest rates by. Now, there are a lot of parts of this CPI, or Consumer Price Index, that go into what the Fed determines is important and determines how they are going to raise interest rates, or at least by how much. And those factors are things such as the headline CPI, which is all price increases, the entire inflation for the whole economy. And then there is something called a core CPI, which is the overall inflation, but minus food and energy. So the core CPI is the one the Fed really looks at, because that is the one that monetary policy, that's what the Federal Reserve has control over, that is the one that the Federal Reserve is able to control. The Federal Reserve can't really control food prices and energy prices because these are set globally, and the central bank just does not have enough control over those two things. Those two things have to be set by fiscal policy, and fiscal policy is set by Congress and the president. So when we're talking about the Federal Reserve, we're talking about monetary policy. We're really talking about core CPI. And that is what we have to look at. Now, so far, core CPI has been dropping month over month. And that's the other figure. You have to understand that when we look at CPI, or inflation, normally the number that you see is the year over year. So, for example, last month it was 8.5%. The month before was 9.1%. And while 8.5% year over year inflation is still quite high, we do have to understand that the month-over-month inflation was 0, meaning we did not see an increase in the rate of inflation. And that is really what the Fed is looking for. The Fed is looking for the rate of inflation to start coming back down, because that shows that the Fed's rate increases are working. So what are people expecting the CPI number to come in at, and how will this affect the Federal Reserve as far as how much they might raise interest rates next week? Well, we'll talk about what we can expect for CPI in just a minute, but first, let's get through the rest of the economic news that's coming out this week. On Wednesday, the PPI, or Producer Price Index, is being released. Now, the PPI is very closely related to the CPI. These are both inflationary numbers. Generally, when we're looking at the PPI, or Producer Price Index, this runs about 1 to 3 months ahead of where we could expect the CPI, or Consumer Price Index, to be, because whatever it costs producers to produce the goods that consumers buy, producers are going to have to raise prices of those produced products, and those higher prices will get reflected in the CPI, or Consumer Price Index. That is, the higher prices that producers raise will get reflected in the higher prices consumers spend over the next 1 to 3 months. So the PPI is a really good indicator to see where inflation might be in the future. On Thursday, we also have some more economic news, although this is mostly going to be overshadowed by the CPI numbers that are coming out on Tuesday. On Thursday, we have the U.S. retail sales, and we also have the weekly initial jobless claims. Now let's talk about where we can actually expect the CPI numbers for August to come in at and how this might affect the stock market, as well as how this might affect the Fed and how much they might raise interest rates next week. Inflation did show signs of easing in several industries in August, although certain sectors did rise. Energy and travel across the board decreased in August. We know that gasoline prices fell sharply, airfares dropped, used cars dropped, and hotels dropped as well. Even rent increases showed signs of slowing down. On the flip side, food prices soared, and a range of goods and services were much higher as well. So with this mix of some sectors being higher and some sectors being lower, it's very difficult to make a prediction as far as where the CPI might come in on Tuesday. Nobody really knows. Now, one estimate called Price Stats is actually predicting inflation to be negative month over month. That means they're actually predicting that there was a slight deflation month over month. One thing I would point out, though, is if you look at the blue line, which is the actual CPI numbers, and then you look at the price stats here in yellow, you'll notice how the CPI is almost always higher than where the price stats estimate comes in at. There were 3 points in the past 2 years where the CPI actually came in lower than the price stats estimate, but other than that, it's always been higher. So again, this is just one estimate, but at least one estimate is showing for a month-over-month deflation. How the stock market responds to this information is really going to boil down to what the stock market thinks the Federal Reserve is going to do next week. Now, if the CPI comes in lower than expected, let's say it does show a month-over-month decrease, even a 0.25% month-over-month decrease, that would be the first decrease we have had in well over a year. And that would be a very good indication that the Fed's raising of interest rates is working, and the stock market would most likely rally. I mean, we're already up 5% in 4 days, but we could see the stock market continue to rally and possibly even go up another 5% over the next 4 days. The reason is because a lowering inflation rate would mean that the Fed would not have to be as hawkish in raising their interest rates, and that would be good for stocks. It should help stocks rise. Now, if the CPI is a surprise, let's say it comes in higher than expected. Let's say we show a month-over-month increase in inflation. That would mean that all of the efforts of the Federal Reserve are still not working, and the Federal Reserve will have to remain hawkish. That is, the Federal Reserve will have to continue to raise interest rates at a very fast pace, and that would be a shock to the markets. The stock market would most likely tank, and we could see the stock market fall as much as 5% over the next 4 days. So whatever this inflation number comes in at on Tuesday is going to have a significant impact on the stock market this week. Now, let's talk about how the Federal Reserve might respond to the CPI inflation numbers, because the answer might shock you. The Federal Reserve is still backing another large rate increase despite inflation coming down. As Fed Governor Christopher Waller said, inflation is far from our goal and more action is needed. Federal Reserve officials have been debating whether to raise interest rates by 0.5% or 0.75% at their upcoming meeting on September 20th and 21st. What's interesting is that they have not pushed back against market expectations of a bigger move. In the past, when the market started to think that the Fed might possibly do a 1% rate increase, the Federal Reserve pushed back on that and they said, no, that's never going to happen. That's way too high. We're not even considering that. This time around, as the market is looking at possibly another 75 basis point rate hike, the Federal Reserve has not been pushing back. In fact, they've left it wide open as a real possibility. Fed Governor Christopher Waller said, "Looking ahead to our next meeting, I support another significant increase in the policy rate. Such an increase is necessary to get the policy rate to a setting that is clearly restricting demand." In other words, the Federal Reserve's interest rate is still below inflation, meaning technically the Federal Reserve is still supporting the economy. They're still, in a way, sort of printing money. The rates are still technically negative. So technically the Fed is still actually supporting trying to grow the economy. And Christopher Waller is saying, look, we've got to get this reversed to where the Fed interest rate is higher than inflation so that the economy will actually start contracting and inflation can come down. Cleveland Fed President Loretta Mester said elevated inflation was leading her to conclude the central bank would need to raise the central bank's benchmark federal funds rate to around 4% somewhat sooner than had been expected. Now keep in mind that the market is currently predicting that the Federal Reserve is going to end this year at a 3.5% Fed funds rate. But if we end the year at a 4% Fed funds rate, that means the Federal Reserve will have increased interest rates much faster than expected, and that will certainly put downward pressure on the stock market. But what if the CPI numbers on Tuesday come in lower than expected and actually show deflation for the first time? That would change the Fed's policy, right? Well, not necessarily. Mr. Waller's remarks explained why a slowdown in August inflation would not meaningfully change his near-term outlook. He pointed to how a short-term deceleration in inflationary pressures last year led the central bank to delay plans to withdraw stimulus, and inflation subsequently accelerated. The consequences of being fooled by a temporary softening in inflation could be even greater now if another misjudgment damages the Fed's credibility. So Mr. Waller said, "I will support taking significant further steps to tighten monetary policy." In other words, Christopher Waller, as well as many other Fed officials, support significant rate increases throughout the rest of this year in order to get inflation down, regardless of what those CPI numbers come in at on Tuesday. So it's very possible that we could see the CPI numbers come in Tuesday lower than expected. We could see the stock market rally, and then we could see the Federal Reserve come out next week and do a 75 basis point rate hike or 0.75% rate hike, and we could see the stock market turn around and absolutely tank. So whatever happens this week is not a guarantee of what's going to happen next week. In other words, if you see inflation come in low and we see the stock market rally this week, don't expect that that means the stock market is automatically going to keep rallying the next week and over the next few weeks. It's not necessarily the case. This week will be determined by the CPI. Next week will be determined by the Fed, and the Fed may not follow the CPI in making its decision this time. Now, as the Fed continues to raise interest rates, this is causing fears of a recession, and it's actually one of the reasons why oil prices are down. Oil futures are down because futures traders are expecting a global recession that will significantly decrease the demand in oil. On the flip side, there is still a case for a soft landing. A soft landing is when we get inflation down without causing a major recession. Prominent economists, including Larry Summers, predict that a recession is coming, and half of Americans think the U.S. is already in one. The gloom has felt justified. The odds don't favor a soft landing. Still, the chances aren't zero. Nearly 50% of the economists surveyed think that a recession is coming in the next 12 months. But the Federal Reserve still thinks that they can achieve a soft landing. Now, the main obstacle to a soft landing is really the historical record. There have been 3 soft landings since World War II, one in 1965, another in 1984, and the third one in 1994. And in all 3 of those time periods, the Fed was not trying to push inflation down. It was just trying to keep inflation from going higher. At times like we currently have, where inflation is too high and the Fed is trying to get inflation down, a recession always occurs. Now, aside from the historical record, Goldman Sachs is the one company that still thinks that we could have a soft landing. In fact, Goldman Sachs only puts the chances of a recession at 33%. And the main reason they think we could have a soft landing is really the job market. The job market remains extremely strong. There are still 1.6 jobs available for every unemployed worker. And even as the number of layoffs start to increase, unemployment remains at historically low levels. And this isn't really showing any signs of changing. Before unemployment can rise, we have to get through all of the excess job inventory that's out there. And that doesn't look like it's going to happen anytime soon. Goldman Sachs thinks that we will be able to get inflation down before the excess inventory of jobs is exhausted. Meaning, Goldman Sachs thinks inflation will come down below 3% before we get to a point where all of the excess jobs are gone and the unemployment rate starts to rise. Now, Goldman Sachs is the lone economic bank here that thinks that. Everybody else thinks we're pretty much going to enter into a recession, but who knows? We don't know the history. I just want to give you a couple of different scenarios so that you know what to look out for and you can start planning your portfolio. Of course, it's really important not to be 100% bullish in a market like this, and it's really important not to be 100% bearish in a market like this because we just don't know what the future holds. The 2 things that I might think about doing during this time would be to continue to dollar cost average into the stocks that are like in case the stock market decides to rise some more, as well as buying some put options to hedge my portfolio in case the stock market does go down. Since we just don't know, it's very important during this time to be very cautious and to not be going all in any one stock and to not just be this huge perma bear. You know, you hear these guys, they predicted all 20 of the last 3 recessions. It's important not to be in either boat. You really got to just take this day by day, look at the news, and find out what's happening. Of course, I'm going to be covering all of the news on this channel. I will keep you guys up to date. So make sure that you like and subscribe so that you don't miss any of the important economic news that's coming out. And I will see you guys tomorrow.